Floor trader pivots have been used by professional traders for many years to understand the price action in stocks. They work best in NASDAQ Global Select Market stocks, New York Stock Exchange listed stocks, U.S. equity indexes, and futures on U.S. equity indexes. Floor trader pivots can be used for day trading stocks and equity index futures. Using floor trader pivots can improve swing trading performance by improving entries, improving exits, and avoiding entry into bad trades. We recommend the traditional 5 floor trader levels. The pivot point marks the dividing line between the bulls and the bears. Above the pivot point, there are 2 levels of resistance. Below the pivot point are 2 levels of support. The values for each level are calculated using the high, low, and close of the previous day. The 5 levels can all provide either support for falling prices or resistance against rising prices. The interaction of the price with the level will provide valuable information for making buy and sell decisions. The floor trader pivot support and resistance levels are relatively weak and are broken often, but they have good intraday value in understanding price movements. In swing trading, you will use the floor trader pivots to improve your entries once you have determined to enter a trade and improve your exits once you have decided to exit the trade. The first rule is to sell resistance if it holds. Selling can be going short or exiting a long position. The second rule is to buy support if it holds. Buying can be entering a long position or exiting a short position. Rule number 3 is to buy resistance if it breaks. Rule number 4 is to sell support if it breaks. The pivot point is the weakest of the levels in terms of support and resistance, but provides valuable insight into the trading conditions. If the price is above the pivot point, then the conditions are more favorable to opening or maintaining long positions and exiting short positions. If the price is below the pivot point, then the conditions are more favorable to opening or maintaining short positions and exiting long positions. If a day has a large range between the high and the low, then the following day's levels will be spread wide apart. Under these conditions, the levels are much less effective. A classic bearish reversal pattern is to fail to breach a resistance level, followed by a weaker second attempt. When the second attempt fails, then the bulls lose control and the price falls until support can be found. Continuation patterns are when the interaction of the price with the levels suggest that the price will probably continue in the same direction. In this final example, the price made it through R1 on the second try, pulled back to the breakout level, and then moved up to S2. At S2, it encountered stiffer resistance, but still made it through by using continuous pressure on S2 until it broke.